Okay, so hello, welcome everyone. This is our Q3 2026 quarterly sustainability pulse. My name is Andrew Haschka, and we'll be covering the last 3 months of news, region by region, May through to August, plus a 6-month forward look to January 2027. We'll move through 5 regions, then zoom out to cross-country and region-cutting themes, tying them together with a forward-looking timeline and what it all means strategically. So we'll typically aim to cover each region first, and then we'll dive into the broader outlook as a whole. So any questions that we've got, please feel free to relay them through off the back of the session. Drop them in chat or follow up via the thread or the post after this. So before we go region by region, here are 5 stories I'd want to walk through with you. And if you're going to walk away with some things from this session, maybe remember, the key stories on this slide. First, Europe has formally simplified its rules. The Omnibus 1 is in force, and the revised ESRS were adopted in July on the 3rd, cutting reporting burdens by roughly 61% on data points. Secondly, the US is doing the opposite of consolidating. Federal rules are being rolled back, but New York is stepping into the vacuum with its own disclosure bill, and companies are quietly maintaining spend while dialing back public ESG language. So that's the green hushing trend that we're seeing at the moment. Third, Asia's carbon markets are maturing unevenly. India stood up a new trading platform. China had a rocky reset in its ETS. Fourth, capital keeps flowing to Latin America, even amid global uncertainty. 44% growth in multilateral climate finance is a big number. And fifth, the Gulf's hydrogen mega projects, especially NEOM, entering their final stretch. We'll unpack each of these as we go region by region and consider what that means as a whole. So in North America, it's a story of contrasts right now. At the federal level, we're seeing continued deregulation. Agencies are unwinding Biden-era climate disclosure rules, but states aren't waiting around. New York's Climate Corporate Data Accountability Act passed the Senate 40-22 and is moving through Assembly. If it passes, it mirrors California's SB 253 and will require companies over $1 billion in revenue to disclose Scope 1, 2, and eventually Scope 3 emissions starting in 2028. So keep an eye on that Assembly vote and Governor Hochul's decision. The more interesting undercurrent is what some are calling green hushing, when companies are quietly increasing sustainability spend, 87% of them by one estimate, while pushing back on public ESG messaging. Only a quarter of S&P 500 companies are using the word ESG in their report titles this year, which is down from 40% 2 years ago. And nearly 4 in 10 North American CEOs say the environment isn't a growth priority for 2026. So that's a much higher number than what we see in Europe or Asia. So less talk, but not necessarily less action. Over the next 6 months, watch the state-by-state patchwork keep growing. Illinois and New Jersey have similar bills in motion. Europe, on the other hand, is the mirror image of North America this quarter. Formal, deliberate simplification rather than rollback. The Omnibus 1 directive has been in force since March 18th, and it substantially raises the bar for who's even in scope. CSRD now only applies to companies with over 1,000 employees and 450 million euros in turnover. Is up from much lower thresholds. So the CSDD's threshold is even higher at 5,000 employees and 1.5 billion euros. The bigger news, though, is from July 3rd, where the European Commission formally adopted the revised ESRS, cutting mandatory data points by 61% and reducing reporting costs by more than 30%, according to their own estimates. Now, that's a real simplification, not just political messaging. There's a 2-month scrutiny period underway now with Parliament and Council before this is legally binding. And so that's the thing to watch through Q3 and Q4. Now, for any customers, this is the moment to reassess who's actually in scope. There's a lot of Wave 1 companies that started reporting for FY 2024, and they may find they're now out of scope for 2025 and 2026. So don't assume last year's compliance plan still applies. Asia Pacific this quarter is really a story about carbon markets maturing unevenly. India launched a centralized carbon trading platform back in March, which is a significant step for the market that's been fragmented. China's story is more dramatic. Regulators have restricted the use of older vintage carbon allowances. It's a bit like telling a bank that old banknotes are no longer a valid currency. That forced a wave of selling and pushed prices down to a near record low of about 52 yuan before regulators stepped back in with expanded banking quotas. And prices have since stabilized around 80 to 81 yuan. This has become mandatory in Japan with Japan's SSBJ sustainability standards closely aligned with the ISSB. So for this fiscal year, the prime market companies roughly above 20 billion market cap. Don't overlook the AI angle. Hyperscaler investment in the region is projected at over $500 billion this year, and that's putting real pressure on grids and renewable build-out timelines for the next 6 months. Watch out for continued ETS stabilization in China and whether India's platform starts to scale. Now, Latin America is arguably quite good on this quarter from a good news story. Multilateral climate financing to the region rose 44% year on year in 2025 to $22.7 billion, which is more than double the global average growth rate of 21%. So it's real capital showing confidence in the region, even as broader geopolitical uncertainty rises elsewhere. On the ground, we're seeing tangible project activity. Colombia just issued its first ever geothermal exploration permit in July, and there's meaningful follow through from COP30 in Belém last November. Brazil, Colombia, and the Netherlands are building fossil fuel phase out and deforestation roadmaps outside the formal UN process, which came out of an April conference in Santa Marta. One cautionary note is that the Amazon itself, deforestation monitoring showed some alarming spikes earlier in the year, though the official annual figures came in with an 11% decrease. So it's a mixed picture. It's not a clean win. Going forward, though, watch Brazil's sustainable taxonomy to start direct real capital flows and expect the region's climate finance to be in front and center heading into COP31. So the last region, Middle East and Africa, and the headline here is infrastructure reaching the finish line. NEOM's green hydrogen complex, the world's largest of its kind, is now about 90%. 4 gigawatts of combined solar and wind power is on track to finish by mid-2026, with electrolyzer commissioning to follow and the first ammonia exports targeted for 2027. This is an $8.4 billion project, so it's a meaningful proof point for the whole green hydrogen thesis in the Gulf. ACWA Power, one of the co-developers, just picked up additional Saudi export rights, extending hydrogen and renewables portfolio that now spans 15 countries. On the African side, momentum is building behind African Union's green hydrogen strategy adopted last year. The message from the AU has basically been stop talking, start legislating at the national level. And the regional investment forums, Middle East Energy in Dubai, the World Future Energy Summit in Abu Dhabi, get the dialogue going on hydrogen, AI-driven energy systems, and green finance. Yeah, watch for that mid-2026 renewable completion milestone, and for more offtake agreements as NEOM financing structure matures beyond its single confirmed buyer. So stepping back from the regional detail, five forces are cutting across all of this. First, regulatory divergence, not convergence. Europe is simplifying. The US is deregulating federally while states pick up the slack. And Asia is building entirely new carbon market infrastructure. There is no single global standard emerging, and I don't think there'll be one anytime soon. Secondary green hushing public messaging is cooling, even as the underlying spend continues, which matters for how we advise clients on communications versus operations. Third, and this is becoming impossible to ignore, AI is now a genuine energy planning variable. Hyperscaler build-out is putting real pressure on grids, especially in Asia. And fourth, carbon markets are maturing unevenly, progress in India, volatility in China, and continued credibility questions in the voluntary market. And fifth, climate finance is following emerging markets, with Latin America the standout this quarter. So if you're advising your leadership team or advising other clients, these are the five threads that are probably more useful for strategic planning than any single regional data point. So here's the calendar I'd keep on your desk for the next 6 months, late August into September. Climate Week, New York City happens right as the EU's ESRS scrutiny period is expected to conclude. So watch both simultaneously. September into October, Fiji hosts the COP31 pre-COP meeting, and Tuvalu hosts a special Pacific Leaders segment. Worth noting, given how Central Pacific and small island priorities are shaping up to be for this COP. October into November, we're expecting a decision one way or another on New York's disclosure bill. The big one, COP31 itself, November 9th through 20th in Antalya, Turkey. The first co-hosted COP UNFCCC history, with Australia leading negotiations. Climate finance, particularly operationalizing the new collective quantified goal, will dominate, and heading into the new year, NEOM's electrolyzers should start commissioning. The EU member states began national transposition planning for the revised CSRD. So if you track one date from this slide, make it COP31 in November. That's where a lot of these threads will converge. So to close, four things I'd want you to take back to your own organizations. One, plan for continued fragmentation, not convergence. There is no universal reporting standard on the horizon. So build a compliance muscle for multiple jurisdictions rather than betting on one template. Two, reporting itself is shifting from compliance cost to capital access lever. We saw that clearly in Latin America this quarter, where credible disclosure and taxonomy alignment are directly correlated with financing flows. Three, AI-driven energy demand needs to be on your sustainability planning agenda now, not in 12 months' time. It's already reshaping grid and renewable timelines in Asia and elsewhere. And four, mark your calendar for COP31 in Antalya this November. And that's where climate finance commitments will most likely be tested and renegotiated. So that's the full picture for this quarter. Happy to take any questions, or as always, do reach out to Strategy&Ops Consultancy if you would like to go deeper on any of these concepts, regions, or customize for your specific business needs. So thank you so much for listening, and we'll see you in the next quarter.